November 17th, 2023. The only real measured move we got today that I thought was of significance was from the 29 open to the 33 close, which is essentially, a bull spike, and we got a measured move up of that bull spike after a deep pullback. And additionally, a lot of times on trading range days, especially, late in the day and it's late in the week, you're going to get a vacuum test of the open of the day. And that's exactly what this was. You can see this is the open of the day. And late in the day, we ended up getting a vacuum test after the failed breakout. I thought there were a lot of reasons why the breakout failed, but I'll go over that once we get to that part. It was a really small day today. We've had a couple of really small days today, or a couple of really small days over the past, basically this week. Today was only a 21 range day, and I think yesterday was like 24. And I thought something really important happened on the open today. We tried to trigger above yesterday's high, and we ended up failing on bar one, so we were not able to trade above yesterday's high. But we got so close to that magnet that I thought we would have to test it and see what was up there. One of the reasons being, well, the highs and lows of the prior day are always magnets. So if you get that close to it, you're generally going to have to get to it. But I thought that it was a high one on the daily chart. And so I thought the high one on the daily chart, the bulls would probably want to trigger it and see if there were more buyers or sellers up there. And so I thought, I was pretty sure that we were going to end up getting there at some point today. Bar one, big bear bar, but big tail on the top, big tail on the bottom. Low probability swing, expecting it to be the high of the day. If you do that, or hoping it's going to be the high of the day, definitely not expecting it to be. Maybe 20% chance. Some follow through for the bears on two, but it's really not that impressive. I think if you're selling below one, you want to see, a really huge bear bar, something like this. You want to see that and like a massive sell off, and you really just didn't get it. Interesting. So if you sold the close of the here, you were never quite let out. You could argue that, you sell more below a bar like that and then you got out there. But, maybe possible that, maybe these sell to close bears sold more below there. They're getting out, but I'm getting distracted. Anyways, bar three, follow through for the bears, but a big tail on the top and the bottom. And to me, there's an 80% chance of a minor reversal on the open every single day. So to me, at this point, it seems more likely that we're going to end up going sideways and expecting a leg or two up. And that's what's happening on bar four is bears, any bears who are selling here know it's low probability, so they're going to be quick to get out. So when three's getting bought up, they start buying back their shorts, during three on the close of three, and that's causing a rally up on four. Some limit order bears will sell above four. In general, by the way, when you get a trading range this tight, just don't trade. Unless you're really, really, really comfortable limit order scalping. But if you're that comfortable limit order scalping, you're probably not watching this video. So just be really careful on these types of days, because you really just don't need to be trading in this. There's going to be a breakout at some point. There'll be better trades later. So I just think it's generally better to not trade. Bar five, outside up, and bar six is an inside bar. And when you see bar six, I think it's pretty tempting to want to buy to get to yesterday's high. But realistically, you don't usually get that vacuum test right here above six. Very occasionally, you're going to get a vacuum test up of the high and yesterday's high, but it's probably not going to get a strong close. The reason being, this is a strong enough sell-off that we're probably going to get another leg sideways to down. And, the bulls haven't really been all that convincing yet today. So I don't think buying above six is all that great. If you do take the buy, you get bad follow-through on seven. You can see there was a micro gap down on the close of six, so traders were pretty much selling immediately. And if you do buy above six, you were hoping that we were immediately going to race up. And I think it triggered like 4.5 minutes into the bar. So really not what you want. And any trader who did take the buy was disappointed in seven, is selling out around break even during eight. That's why we went exactly to that high. And no surprise, anyone who, bought and had a stop here gets stopped out on nine, and then the market reverses up. It's a trading range, so tight stops are going to get run. Limit order, traders who are willing to scale in are going to most likely be forgiven. Bar eight, outside, but it's outside down, but doesn't close very strong. The context isn't that good. Nothing to sell. Nine, big bear bar, or it was a big bear bar at one point, but it ends up just being a doji bar. And even once you get bar 10, there's a lot of problems with this whole rally. I mean, if we're going to get a big breakout to the upside, you want 10 closing on its high. It's early in the day. You want 10 closing on its high. You want big follow through on 11. And 10 has a big tail on it, and 11 has a big tail on it as well. So even if 11 closed on its high and triggered, I still don't think it's a very good buy. There's way too much overlap with this tail, and it seems more likely that we're going to go sideways. Additionally, this is a tight trading range, and in tight trading ranges, traders who scale in should be forgiven. So the traders who sell above 9 are most likely going to make money. If they're going to get trapped, 10 needs to close on its high. This gives bears confidence that they're going to be able to get out by scaling in. So they'll scale in more above the bar. 12 trades down, and we probably need one more leg up. You could argue that this is 1, pullback 2, pullback 3, so some sort of wedge, and then essentially wedge top at the top of a trading range. Some traders would just argue 1, pullback 2. There are lots of different ways to look at this stuff in a trading range, and that's how you know you're in a trading range, because nothing is clear. 13 lets those traders out, but 13 can't close on its low, so it's kind of disappointing for the bears, and that's why you get bad follow through on 14. Outside doji bar on 15. Again, anyone who sold below 13, disappointed 14, getting out during 15. 16 is a double bottom, but you're buying high in the trading range, and you're buying in a tight trading range at the top of it, and there's a big tail on top of 16. So buying higher in an overall trading range to the top of a tight trading range in a doji bar is really almost never going to go well. 17, some follow through for the bulls, but there's a big tail on the bottom. We're probably at least getting back to this high. And if realistically, if you were going to buy, if you were hoping that, 17 was going to be the follow through that you wanted, if you bought above 16, and, do you really feel all that strongly about 17? Probably not. If you bought above 16, you were hoping you were going to get a bull bar, probably like a bigger version of bar 30. You were looking to get a big bull bar closing up here that had almost no tail on the bottom, showing that bulls were immediately interested in buying. And you're just not getting that on 17. So bulls are getting out. Additionally, anyone who bought the close of 11 is disappointed. They scaled in lower, and they sold out a little bit before break even, you can see. 18, it's 3 pushes up. It's probably the most logical sell, or probably the most logical trade in general so far on the day, but it's still really not very good. You're on a flat moving average in a tight trading range. You're able to sell a little bit higher in the trading range than you have been, earlier, but I still don't think it's a very good trade. I'd just rather wait for a breakout. And you can see 19, you can see any bear who sold below 18, their entry price, so it needs to get to 45, 14.5 for bears to make 5 points. And the problem with that is it's basically, right around the low of the day. So right where that bears are going to be probably scalping for 5 points because of how sideways this is, and that's right at the low of the day. So bears are probably going to be buying back shorts down here. So do you really want to be selling this breakout? Probably not. Additionally, 19 doesn't close strong, and if 19 closes on its low, it's possible that bears are selling, hoping they're going to get a swing down, but it doesn't close strong. So the rest of the traders that end up scalping out at the new low, and that's caused the reversal up on 20. Again, I thought 20 was the most logical buy so far on the day, probably in general the most logical trade. But you're still buying in a tight trading range right at the moving average. It's okay because, I thought it was likely we were going to get above this high, and we're probably not going to go that far down, that much further down in general. And you can see 2 to 1 of the true risk. You can see the true risk ends up being the low of 25, right? So if you bought above here, your stop only had to be right here. You don't know that going into the trade, but once it's up here, you realize this was your true risk. And exactly 2 to 1 of that is 1 tick above the prior day's high. And that's not a coincidence. That's the algorithms creating that trader's equation. So it's logical for bulls who bought above 20 to take profits when we get to a new high, because they get 2 times their risk on a lower probability trade. And it is a lower probability trade because it's in a tight trading range, right? So you could buy above 20, but it's kind of hard to want to sit through all of this, this mess right here. Bad follow through on 21, probably buyers below 21, but the pullback could be, I think, a little deeper than you'd like it to be. 22, disappointment. So, bulls who bought above here were hoping that if this triggered, it would immediately reverse up. Instead, what ended up happening was the bulls who bought above 21 bought above 20 exit around break even during 22, as you can see right here, which this is at the entry price. 23, it's a second leg up for the bulls, but again, a big disappointing tail on the top. So, it's really hard to want to buy. 24, probably buyers below 23. So not surprising that we get a big tail on 24. And obviously no one wants to sell below 24 at the bottom of a tight trading range. So you get a reversal up on 25. And, at this point, it's, the reversal and 2-legged pullback, potential buy above 25. But I think it's just you're better off just not taking any of this stuff because, your best case scenario isn't all that great. And your worst case scenario is you're just going to get completely chewed up in this whole thing and lose a bunch of money. 26, bull bar, but big tail on the top. 27, same problem. These are, if you bought above 25, it's really not quite the follow through you want, which is very common on trading range days for nothing to look quite right and nothing to be all that good. Bad follow through on 28, but buyers below after 3 straight bull bars, probably another leg up. outside up bar on 29, just trading range price action. And I thought 30 was an interesting bar. It's the best looking bull bar so far today, and it's you know we're probably getting up here, so it's probably a reasonable buy above 30. But it's pretty hard to want to do because you had three dojis. This could be a one pullback two, so it could be a second leg trap. You've had a lot of dojis over the past couple of bars. 3 out of the past 5 bars have been dojis, right? And then 26 and 27, they aren't dojis, but they're really not anything great for the bulls. So it's hard to want to buy above 30 so high in the trading range. And I think it's one of the reasons the bar gets bad fall, or it gets good follow through, but how good is the follow through, right? If you're buying above 30, what are you hoping is going to happen? You're probably hoping for more than just a break up to this upside. You're probably hoping that we're going to get some sort of measured move up, maybe up here, something like that. And if you're going to get that, you're hoping that bulls are going to, come in. I mean, this is the beginning of the trend, right? 30, if you're buying, you're hoping it's the beginning of a swing and a good trend. And the opening range is pretty small so far. So theoretically, the range could double. So you're hoping that we're going to get a really strong bull breakout. It's unlikely because of the trading range, but that's what you're hoping for. And when you get 31, is that exactly what you wanted? No, it's a bit disappointing. Why is there a big tail on the top? Why is there a big tail on the bottom? And then you get 32 and bulls are scalping out at the new high. So this isn't right. If you're buying above 30, this is the start of the trend. You want to see strong bull bars closing strongly on their highs, and you're just not getting it. And so that's why, you get another disappointing bar on 33. Their bull closes, sure, and it's probably always long above 30, but this isn't exactly what you want. And so you have to be ready for probably a pretty deep pullback. And that's why when you get 34, a lot of bulls exit below 34. Again, this is the test of the prior day's high, and it's triggering a high one on the daily chart, and high ones usually lead to trading ranges. So there's low probability that we were going to trigger the high one and race up. And if that was what was going to happen, 31 would have been a strong bull bar closing on its high. 32 would have been a strong bull bar closing on its high, and we would have just raced up. But that's not what happened. We got trading range bars, and that's why traders exit below 34. You get good follow through for the bears on 35. I thought occasionally when you get these high ones, it'll trigger and then go outside down. I thought there was a chance of that happening, but I was hoping, that this was going to end up being a wedge pullback, and that, 43 was maybe going to be an outside down bar, or we're going to get some sort of big bear bar. But instead, we ended up getting basically kind of a poor sell, and I'll get there in a second, actually. 36 follow through for the bears from 35, but, there's a big tail on the bottom, so we're probably going to at least get a pullback and potentially a lower high. This is a trend line break of this, so bears hoping for a lower high major trend reversal. Additionally, look at how parabolic this got, right? Not all that great. So we're getting a pullback, 37, low 138, not very good. Wait for more price action. Outside up on 39, and you could argue that we're in a bull channel, which is what we ended up being, and we were in a bull channel. But it doesn't close all that strong, so that's why you get bad follow through on 40. 41, a bull bar. We're going to now have 3 pushes up. Bears try to get a breakout to the downside on 42, but it gets bought up. 43, again, they're trying to form some sort of basically wedge pullback and a lower high, and maybe potentially a major trend reversal for a swing down to a new low on the day. There's an 82.5% chance we're going to break out of the 36 bar range. So, and we haven't yet. So it's possible that, we get 1 or 2 good bear bars and we start to race down. It's still early enough in the day that can happen. But is 43 when you wanted to see? Not really. It has a tail on the bottom. It's closing right on the moving average. It's not breaking out of anything. So I don't think you can sell below 43. And then you get a bull bar on 44. I think it's okay to buy above 44. If you do it, you're hoping for a breakout above the wedge. I think it's probably pretty close to 2-1. Not quite, but that's what you're hoping for if you're buying above that. And you get good follow through on 45. And I think 45 is a surprising bar. It was the first time today that anyone had really gotten, somewhat ideal follow through. There is a tail on the bottom of 45, which is disappointing, but the bar is a pretty strong close, and so it's reasonable to think there's going to be buyers above. We might be at the top of the bull channel, which is definitely always a risk. So we might have to go more sideways first, but I think it's a reasonable buy above 45. But you just have to realize that, it's a bull channel. It's not, a strong bull trend. So you're probably going to have to sit through a couple of pullbacks. And that's exactly what happens on 46. You get disappointing follow through. Inside bar on 47. So it could be spike, pullback, and then channel. And basically this was the spike. This is a pullback. And then we got the channel phase. It's also kind of consecutive buy climaxes. Another reason why we ended up reversing down. So consecutive buy climaxes. But anyways, we get a two-legged, so we get the spike, and then we get a two-legged correction, and then another breakout to a new high on 49. And at this point, bulls are hoping that we're going to basically get above the high of the week and see if we can get a lot of follow through. And it makes sense because that's essentially this high, and that's a breakout point. So bulls want to see what's up here now, but we're not getting convincing follow through, right? If we were going to get up there, this pullback was okay, but if we're going to get up there, you're hoping that 49 is going to get great follow through with 50, and again, you get kind of a disappointing doji bar. 51, a reversal down, but it's a tight bull channel. You don't need to sell. I think always in bulls can hold. Bad follow through for the bears on 52, which is to be expected. 53, a second leg down, so it's another two-legged correction. It's kind of trying to test the bottom of the of the buy climax. But again, if you were buying up here, is this what you wanted to see? No, it's not. But you have to recognize that if you're buying this breakout or something, you're buying in a bull channel. So you're not buying in a bull trend. So if you're buying in a bull channel, it makes more sense to be buying pullbacks, buying a point below 51 or something like that, scalping out at the new highs. Because, in general, you can see once we get these bull bars to new highs, bulls are using them to take profits right here. Bull bar to a new high, some bulls take profits. Bull bar to a new high, some bulls take profits. So two-legged correction, 54. Once you see 54, we're probably going to at least this high and see what's up there. Kind of, okay follow through on 55, but again, a big tail. And I thought 56 was an interesting bar. If you look at this, this is probably the strongest move since the beginning of the trend, which you could argue was here. You could argue spike, pullback, and this whole thing is a channel. I think that's reasonable too. And you have spike, pullback channels within the channel. But when you get this something this strong, this late in the bull trend, and you're in a channel and you're trying to break out above the channel line, probably only 25% chance that we're just going to race up here. Most likely, this is an exhaustion gap, and we're going to get back to the breakout point, which you could argue is 51 high, or the bottom of the sell climax or the buy climax. And I think that the 53 high is a reasonable thing as well, because if this is a channel, limit order bears are probably going to make money. We did have an open gap as well. We had a breakout above this, and we weren't able to close that gap. We had an open body gap with this high as well. So we had another open body gap here. So, it was reasonable to think this bull channel was going to continue, but it just ended up getting climactic up here. And so traders quickly took profits on 57. I think it's, definitely okay to get out of longs below 57. I don't know if you want to sell 57. You probably can, because consecutive buy climax is probably a trading range day. You can cite that it's a swing to get back to the open of the day. But this is what trading range days do, right? They start to go maybe it starts to go in your direction, and then it goes and stops you out. So you're selling below 57, you sit through this whole thing, goes and stops you out for a full loss, and then it goes exactly to where you thought you were going to go. And that's exactly what happens on trading range days. So it's hard to trade with stop orders on trading range days. Bar 58 triggers the sell below 57 and does something really important, and it tries to go retest the 56 close. This pullback, bar 57 isn't necessarily the end of the tight bull channel. This can definitely fail and we can continue up. But if that's what's going to happen, what you need is when we get up to this price point, you need bulls to want to continue to buy. So you need a strong bull close up here, which is basically bulls' way of saying, well, we're still interested in buying at this high close. We're still interested in buying. And when we get up to that high close, the bulls who are long just scalp out and they bail out of the trade. And that's what's causing 58. Some of those traders who bail out, they'll flatten their trade and then look to buy if the bar closes strong. But you can see it doesn't, and that's one of the advantages of flattening up here is you can sometimes just buy it back, a few minutes later if it closes strong and you're not in it if it goes down. Can you sell below 58? You probably can. It could be one pullback too, so it could be a two-legged correction. So it's kind of hard to sell below 58, especially with how tight this bull channel is. But you probably could. Kind of bad follow through on 59, a big tail, and then another bear bar on 60. 60, I thought 61 was a bear bar on its low for a little while, and I thought if we got 5 bear bars in a row, that would be, that's the first time today, that would be kind of a lot, and we might just collapse immediately. But we end up getting a small bull bar, and with all these tails, it made me think it's more likely we're going to go sideways and then potentially get a reversal down. 62, outside down bar, but not able to close on its low, so disappointing for the bears. If it did close on its low, probably a reasonable swing sell, but instead we're just at the bottom of a trading range. High 2 reversal up on 63, but it's true that this probably needs a second leg up, but this is tight enough that it probably needs a second leg down. So I think it makes more sense to not buy above 63 and just keep waiting this channel is a little bit too tight. That's why you get bad follow through on 64. An inside bar on 65, and it's a high three, and it's kind of a triangle. And can you buy above 65? Maybe, but I think it makes more sense to just wait for follow through. And on 66, it looks like good follow through, but it's really not. This is a tight trading range, and you want a strong close above the tight trading range. So you want a strong close above the 64 high, but that might not even be enough. Ideally, if you're buying above this, you're looking for an explosive move, and you probably want to close somewhere up here. And you're just, again, on 66, it's a bull bar, but I think for bulls to seriously consider buying, it needed to close above the 64 high, and it just doesn't do that. 67, and that's why you get bad follow through on 67, doji follow through. 68, inside bar. Any bulls who bought disappointed with this or getting out, and bears are essentially hoping to get a breakout below this wedge in some sort of measured move down. Probably just trying to get to about the open of the day, but it's a doji bar, right? So it's hard to want to sell. It's a double top, sure, and a setup, but it's hard to want to sell below a doji bar. That's why you get bad follow through on 69. I think if you buy above 70, you're buying the top of a tight trading range. So I have the same problem with 70 that I had with, it's not in a tight channel as much anymore. So it's a little better to buy. I think it's better to buy above 70 than it is to buy above 65, but you're still buying the top of the tight trading range. And if you're buying above 70, what's your premise? Your premise is that this is big enough for a second leg and we might get some sort of buy the close rally. And if that's going to be the case, doesn't it make sense to just buy later? I think it does. And I thought this was, so where's the top of the tight trading range, right? It's probably the 66 high, or the 67 high. 67 is the neckline of the double bottom with 65 and 70. You can look at it as the top of the tight trading range or the neckline, doesn't matter. But I think what was really important was that 71 closed at it, but not above it. And it was sitting there, basically ticking back and forth between closing above and closing at it. And I was ready and willing to buy if it closed above it. You probably still can buy if it closes at that high, but you have to be thinking it's a trading range day. So things need to pretty much be perfect, and it just wasn't perfect on 71. And so that's what happened up here. That's why all these traders started to scalp out when we got to this high, because, this what didn't close the way they wanted. And this bar got too big. If you're going to get a buy the close rally, it's usually relatively consistently good bars, and this isn't as good as they want it to be. And all these traders, when we get up here, they just scalped out of their longs. And when some bulls see that other bulls are scalping out, they're going to start scalping out too. And that's what's going to essentially causes this massive tail. And if you bought above 71, how do you feel about 72? Probably not all that great. And so when 73 gives you a quick chance to get out at break even, a lot of those traders take it. And any traders who bought on the way up from 72 are, worried they're trapped. And so traders just immediately start dumping their longs. And that's when we start to get this move down. And some bears will get in on it and start selling the market, thinking we're getting back to the open of the day. And that's exactly what happens. We get essentially one pullback, a two-legged correction to the open of the day, and then we find a bunch of buyers. Overall, I just want to look at something. I don't think this is a one leg two. Not really. Overall, these trading range days are pretty hard. We got a pretty good bull bar closing on its high, basically. Not quite on its high, but very close to its high. So we have 3 straight bull bars. I still think we're going to end up pulling back. I think the bulls who buy this close are going to be disappointed. But if they're willing to scale in lower, they're going to make money. And the daily chart, we essentially triggered the high one. We're trying to get a swing up. Low probability that we get a big bull bar on Monday. I think it's more likely that these traders who bought above here are going to be disappointed in this follow through, and they're going to sell it around break even. So I'm expecting a trading range and a pretty sideways day on Monday. All right, that's today.